What's up, guys? Matt Fairclough here from the DeRosa Group, and we're a real estate company dedicated to transforming lives through real estate. And I want to talk today about something that's changing in the U.S. market, and that is $1.5 trillion in commercial real estate that's going to change in value, that's going to be dropping, that's going to be getting pulled out of the market in value. And this is based on a Yahoo Finance article and about the changing commercial real estate market that's coming up. I'll give you my thoughts on how opportunity could be presenting itself for real estate investors to jump on the opportunity for this $1.5 trillion shift that's happening in the commercial real estate market. This was an article on Yahoo Finance about the changes in $1.5 trillion wall of debt is looming for U.S. commercial properties. And the thing is, those commercial properties are no longer worth what they were worth before. So we're going to see a major change in office, industrial, retail, hotel. Look at those bars. Lots and lots of money that's going to be dropping off. Apartments, a little bit below 20% of the market share for lending is going to be changing. And I'll comment to you why apartments is a different animal. We'll talk about that in a second. And then senior housing. It's surprising, right? Look at that. More than 20% of senior housing, about 30% of senior housing is going to be coming due in the next year or so. By the way, if you guys are watching on YouTube, this is being presented live on our DeRosa Insiders channel. That's facebook.com. Search for DeRosa Insiders. It is a free community you guys can join. And I go live here every Friday, and you guys can come on and ask me questions, chat with me, come on live with me, pick my brain. And there's opportunities and discounts for DeRosa programs that get presented here. So take a minute and go to Facebook and join DeRosa Insiders. Let's get back to the article. So here's a few things. There was a perfect storm that happened in commercial real estate. And when I say commercial, I'm pretty much talking about anything that's not residential up to 4 units, right? That all becomes commercial. So commercial real estate in general, including apartment buildings, had a perfect storm in it. And the first leg, call it like the first wave of this perfect storm, was this thing that y'all might remember called COVID, okay? So COVID changed a lot of things around in the world. COVID sped up things that were already happening, right? More and more people were starting to work from home, but COVID took it from here to here, the amount of people that are working from home. Look at the amount of people that are telecommuting. Most people that you know in your circle that have an office job are either working from home completely or on a hybrid model where they work from home part of the time and they go into the office part of the time. But rarely do you see people that have a desk job that were in an office that are full back Monday through Friday, 8 to 5, unless they've got to serve somebody like a retail business owner walking in. Even if they're serving customers over the phone, the world has changed a bit to where a lot of those folks are able to do it from a home office and maybe partially from a desk office, right? So the hybridization of working and the home officeization of working is happening a lot. And we owe that to the acceleration that happened during COVID. The second thing that got accelerated a lot during COVID that was happening already was the Amazonification of the world, right? You want to buy a toy for your kid, you have to get in your car and drive to a local toy store or a Toys R Us or whatever and buy the toy, take it home, wrap it, give it to your kid. And again, Toys R Us is a different story, but if you wanted to buy a physical thing, you likely had to go somewhere to buy it, or like a lot more percentages of people did that. After COVID, a lot less people were buying physical items in a physical store. And it's not just Amazon. Organizations like Target and Walmart and those organizations are now selling a lot of their stuff online. Their online businesses have taken off, partly to make a run at Amazon, but also because people's shopping habits have changed. Again, that was already happening. But again, as I said before, COVID sped up what was happening already. And if you look back at that Yahoo article, there's other organizations like, hotels and things like that also saw a major impact because of COVID, and they haven't fully recovered from that yet. So COVID sped up what was happening already, and that has dropped the occupancy, mostly office and retail. On forward to today, we haven't fully recovered in occupancy and revenue and lease rates in office and retail mostly. And other things too. The complete just bomb that COVID dropped on those industries has nowhere near recovered yet. That's storm number one. Storm number two. Commercial real estate is not like the mortgage you have on your home. The mortgage you have on your home, I hope, is likely a 30-year fixed mortgage. And if you were smart, you got locked in rates a couple of years ago when rates were like, 1, 2, 3%, something like that. You locked in for years, for 30 years. Untrue for commercial real estate. And there's only a few exceptions. You can't lock in your interest rate for that long period of a time. You're locked in for 5 to 7 years somewhere. And sometimes just floating rate debt where the rate changes every month. But for the most part, a lot of stabilized commercial real estate is on fixed rate debt where the rate is what it is, 3% for the next 5 years, or 3% or 7% for the next 7 years. The problem is that locks the rate now, and then at some point you have to refinance or sell, and then the rate changes to whatever the change is. Second storm is that interest rates, partly because of all the money that got printed during COVID and because of all the stuff you guys have heard about, which I don't need to get into today. If you guys want me to get into it, leave a comment on how the first storm of COVID created the second storm of interest rates. So an interest rate major hike happened that took rates, commercial real estate rents. We were getting rates at 3.5% maybe on apartment buildings, and now we're being quoted on the exact same apartment building. We're being quoted 6.5, sometimes even 7. So rates have essentially doubled, or at least added at least 75% to the interest rate. The problem there is that the office building owner that refinanced their office building or bought their office building, or the retail strip center owner that bought or refinanced their retail strip center in 17, 18, 19, and bought it at 2, 3, 4% interest rate, now has had a drop in the income in their property thanks to COVID, and is now going to be subject to a higher loan on the back end. Well, why does that matter, Matt? I'll tell you. I'm glad you asked. So the problem is that real estate is valued partly on how much money it makes, your income on a property minus your expenses. That's like your utilities, your insurance, your maintenance, your property management fees, blah, 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 blah. All that, one subtracted from the other equals your NOI. You divide that by the cap rate, and that equals your property value. Yet again, I can get more into that if you guys would like me to. If you guys want me to discuss real estate valuation terms, I can gladly do that for you in a separate video. That's one way that properties get valued, but the amount of money that a bank's willing to lend to you on the property is partly due to the bank's loan to value restrictions on what they'll do on LTV. And it used to be 80% LTV. You guys remember those days where if you're buying a property for $1, the bank would lend you 80 cents. Well, that hasn't been around for a while. Maybe on residential, that's still out there. But most banks are lending between 65 to 70% loan to value. You might be able to score a 75% loan to value loan, but for the most part, you're going to be on the lower side. And the reason for that is because banks have gotten conservative, but more importantly, and this is where I bring it full circle with rates going up, the loans are becoming something called DSCR restricted. Now, what that debt yield restricted or DSCR restricted, DSCR is debt service coverage ratio. And what that means is how stable is the property and able to pay its debt service, aka its mortgage payment. So the DSCR is a calculation of the amount of NOI a property makes as a ratio of the debt payment. So if your property's making $50K a year and your debt service is $20K a year, that's a nice ratio. But if your property is $50K a year and you're making NOI of $50K a year and your debt service is $45K, well, that's not a very tight. It's a very tight ratio, and the bank might not be willing to lend you enough for your debt to be 45. So if your property is making $50K, the bank will limit how much they can lend you because of how much the monthly payment is. Okay. Now I bring it home for you guys. Ready? If you're refinancing a commercial or an office building or a retail strip center that you bought in 17, 18, 19, right? And you bought it for X and you now need to refinance it because your loan's coming due, right? Your value here used to produce a debt service payment of this. So you buy it for, your value is $1 million. Your debt service could be, probably guessing off the cuff, somewhere around 80 to 90,000 back in the day on lower interest rates, right? But if the rates have gone up, that $80 to $90,000 mortgage payment on higher rates is now 120,000, right? It's more. It's a lot more. So the bank's not going to lend you that $1 million anymore. If your NOI has gone down a little bit, the DSCR restriction is going to cause you to be able to borrow less. So this little hand grenade is a perfect storm that's happening. Commercial strip centers, office buildings, all those things that were bought for big numbers with a frenzy market in 2017, 18, 19 are now going to either get taken back by the bank or are going to be forced to be sold by owners as they need to unload these properties out of their portfolio or lose these properties because they can't refinance to get the loan recast into a new loan, whatever it may be. You're going to see a major shift, mostly in office buildings and retail, and that. So the solution there, guys, is value add. And so if you own assets like this, you've got to do something to push your NOI up. Raising rents, yes. Dropping expenses, yes. Doing something to make the property more interesting, more appealing to the market. Fill in those vacant units that got Amazonified, and for the retail seller that moved out because Jeff Bezos took all their business, whatever it is, that's going to need to shift, of course, if you're an owner of those assets. But the opportunity that it shows up for you guys, for real estate investors, is to step into scenarios like this and to find a solution. So let's say that you're watching and you see a small office building. It doesn't have to be a 100,000 square foot office building that's selling for 30, 40 million, because I get not everybody is looking at stuff like that, and I probably wouldn't look anything like that either. That sounds crazy. But a lot of us could figure out how to do a 500,000 or $1 million office building that was 50% occupied, and to put your thinking cap on and say, well, I wonder what I could do. Could I turn those office units into residential? Could I turn them all into really cool, funky apartments? It used to be an office building, right? Could I turn it into something else, into a data center, into a WeWork, like a shared office space kind of arrangement, right? What is possible? And the $1.5 trillion debt that's going to be coming due in the next year can get shifted into billions of dollars of profit, billions of profit for real estate investors. If we as real estate investors can figure out how to reposition those properties and bring them into today's standards of markets, post-COVID, higher interest rates positioning, right? So that's where a lot of money is going to get made. Is that you? I don't know. Do you guys want to be the fixer? Do you guys want to be the Rockefeller of old office building real estate that comes in and repositions a lot of the stuff and takes over deal after deal after deal? I'm not saying DeRosa is going to do that or not. I'm saying that is a phenomenal opportunity. Again, if you guys want to read this article on Yahoo Finance, click the comments below and or the description for this video. You guys should be able to grab that. Okay. Love to hear what you guys think. Love to hear what you guys think another domino to fall is. The way, and I promise you guys to talk briefly about multifamily. Multifamily, I'm not saying it's untouchable, but it's different because the leases on multifamily are very short term, respectively, compared to retail, where retail and office leases could be 5 to 10 years. Multifamily lease is the most a year, right? So multifamily has been able to stay current with the market as occupancy rates changes, as rents go up, rents go down. Multifamily can stay in tune with the market faster, right? Than office and retail can, number one. Number two, multifamily is easier to value add, and you can because multifamily leases come due more frequently, you can push rents faster. Like I can redo kitchens and bathrooms and those kinds of things and create a better product and have the market respond to that faster than you can on retail. Retail tenant's going to pay what they're going to pay for the next 10 years. And as long as they stay in business, and I can't really value add that lease contract at all until their lease comes due, and then I can make some changes, right? So multifamily, yes, is a factor because multifamily saw major changes in interest rates. We've all talked about that. And multifamily has seen the effects of COVID as well. But if you look at the chart in the article that we're posting here, multifamily is the least of all of them in that. So it doesn't mean it's not affected. It means it's the lowest. So guys, opportunity in office and retail for those that really want to be on the forefront, want to be the Elon Musk of real estate. There is a phenomenal opportunity for those that want to step into the role of repositioning office, industrial, retail spots. That's what I got, guys. Enjoy the video. Don't forget to join us on DeRosa Insiders on Facebook, and like this video. Subscribe to this channel. Would love to hear what you guys think in the comment section too. Thanks for watching and have a great profitable week. If you like this video, here's a few more you might like too. Thanks again for watching. Make sure you subscribe and like this video.